Understanding angel investing and venture capital. You recognize that your business requires financial support. You have the options of taking on debt or equity, seeking assistance from friends or family, or approaching angel investors or venture capitalists. Nowadays, you have numerous avenues to explore. Let's delve into what might be most suitable for your enterprise. Funding can broadly be categorized into two primary types: traditional financing and private equity. Traditional financing encompasses avenues like small business loans and peer-to-peer lending. On the other hand, private equity refers to obtaining funds in exchange for a percentage of ownership in your business. Essentially, traditional financing resembles borrowing money, while private equity involves swapping equity for financial investment. With private equity, investors accept a higher risk, with the expectation of achieving greater returns upon exit. You won't be repaying the investment during the life cycle of your business, as you would with traditional financing. Terminology such as venture capital, angel investors, and seed investment often surfaces in discussions about private equity. Throughout this discussion, we will focus on early-stage financing. After all, your objective is to acquire skills for pitching to your initial investor. The general progression of early-stage funding can be depicted in a specific way. Keep in mind there is no singularly correct pathway. The landscape has transformed over time, presenting a myriad of variations. These variations include micro-seed funding, stepping in for bootstrapping, and securing funds from friends and family members. Bootstrapping refers to utilizing your team's own resources to develop and launch the very first product. Funding from friends and family involves leveraging your personal connections to raise initial capital. Angel investors provide both monetary support and valuable insights in the early-stage funding arena. Typically, angel investors contribute their personal finances and invest smaller amounts than venture capitalists do. However, you will likely engage with several angel investors at once. Venture capitalists can participate in funding from the early stages through to the later phases. It is common to identify one leading venture capitalist who establishes the funding round's terms, alongside several other VCs contributing to the round. Venture firms differ significantly in size and industry focus, which means that investment amounts can also vary greatly. With a clearer understanding of early-stage private equity now, it's time to evaluate whether your business is suitable for venture funding. Most businesses do not fit the venture-backed mold. Seriously, venture funding is not the sole avenue to attain success. Being aware of this from the start can prevent a considerable amount of stress. In summary, venture capital is most effective when your business is still at a nascent stage. This is distinct from lifestyle or family-run businesses. Ventures are aimed at newer companies that have the possibility of being valued in the hundreds of millions. Consider posing a few questions to yourself. Is your cash flow unstable, insufficient, or completely absent due to its premature stage? To put it differently, are you in a pre-revenue phase because your emphasis is on scaling and attracting users? If you find yourself answering affirmatively to these inquiries, it's likely that seeking venture funding could be a viable option for advancing your company in its initial phase. Throughout the remainder of this course, we will proceed with the premise that you are developing a company suitable for venture capital and are prepared to initiate discussions with potential investors.